Hello, my name is Yael Fuchs. I'm the president of the National Association of State Charities Officials, known as NASCO. In the United States, charities are regulated both by the federal government, mainly through the Internal Revenue Service, which grants tax-exempt status, and by the states, which oversee governance and solicitation. NASCO is the umbrella association of state-level governmental agencies charged with charities oversight. NASCO is proud to be a supporting partner of International Charities Fraud Awareness Week. This webinar provides a perspective from the United States on future threats and preventative actions. All of the views expressed are my own and do not reflect legal advice or the policy position of NASCO or any of its member agencies. So let's dive in. What are some of the significant fraud threats facing charities today? US regulators continue to be concerned about sham charities that take advantage of popular causes like cancer or veterans or first responders. We're also concerned about non-charitable organizations that appear to be charities when they solicit. These can be either for-profit companies or political organizations that make it seem as if they provide services when in fact they don't. We're also concerned about individuals and groups that take advantage of social media to raise money for causes without having any group behind them. But we're also concerned about ongoing forms of fraud that occur within well-intentioned organizations. These are instances in which you have a breakdown of governance. Many charities survived the pandemic thanks to grants or loans from the government, and that funding stream is now running out. Others received surges of donations that may not be repeated in the coming year, and others are just dealing with fewer donations. Any of these scenarios can increase the financial strain on charities. According to the Association of Certified Fraud Examiners, the most common fraud schemes impacting charities are corruption, and that includes conflicts of interest or bribery, billing, and expense reimbursements. As a side note, the association reports that while financial statement fraud is less prevalent, it's much more costly. Turning to conflicts of interest, these are a significant risk in charities. This is when the charity engages in a transaction with an officer, director, or key employee of the entity. Now, this type of transaction can certainly be to the charity's benefit. Imagine a provider of shelter services contracting with a director who owns a building, and that director rents the building to the charity for below market value. But we regulators see many instances of the insider taking advantage of the charity and charging too much for services, or charging for services and not delivering at all. Imagine a director who gets paid to identify potential donors, but never provides any return. Now in New York, charities must have a conflict of interest policy, and there are procedures that must be followed if the charity wants to contract with an insider. The insider must disclose the full extent of their interest in the transaction. Second, the board must consider alternative transactions. And third, the transaction must be approved by a majority of the board or a designated committee of the board. We find that these procedures provide the charity with a roadmap for how to avoid improper conflict of interest transactions. Turning to billing schemes, another area in which nonprofit organizations are particularly vulnerable is billing schemes, in which an employee fraudulently submits invoices to obtain payments he or she is not entitled to receive. Billing schemes often involve the creation of a shell company. In such a fraud, a dishonest employee sets up a fake entity that bills for goods or services the organization doesn't receive. In some instances, goods or services may be delivered, but are marked up excessively, with the proceeds diverted to the employee. Other scams can include kickback schemes that cause overpayments to legitimate vendors, And when the overpayment is returned, it's embezzled by the employee. So what are some common warning signals or red flags of potential billing fraud? You may see invoices for unspecified or poorly defined services, invoices from unfamiliar vendors, vendors that have only a post office box address, vendors with company names that consist only of initials. Now, many such companies are legitimate, of course, but fraudsters commonly use this naming convention. You may also see sudden increases in purchase from one vendor, or vendor billings that are issued more than once a month, vendor addresses that match an employee address. That should certainly be a red flag. Or large billings that are broken into multiple smaller invoices that will not attract attention. So what can your charity do to prevent these and other forms of charity fraud? There are a few things. Number one, take advantage of all the resources on the Prevent Charity Fraud website. There you'll find a lot of resources on effective internal controls. Just by watching this webinar, you're on the right path. Second, think through the fraud risks in your organization. Now, most board members and executives and staff of nonprofits don't think as fraudsters do. Of course, that's a good thing, but it can make it difficult for us and you to develop controls that reduce your risk of your organization's exposure to fraud. So how can you get into the mind of a fraudster? Well, consider conducting an anonymous survey of staff and employees to gather input about fraud risks. Those people on the ground are the best situated to have a feel and an understanding for where your fraud risks lie. Also, consider a meeting or a series of meetings to evaluate fraud risks. If your charity engages auditors, they should be part of this meeting. In many instances, a discussion of fraud risk is built into the annual audit process, and skilled auditors will take this discussion seriously. You want to avoid a discussion that simply goes through the same annual checklist. This isn't a discussion that you want to phone in. If you have an audit committee of your board, those directors should also be part of this discussion. And any meeting or meetings should also involve senior leadership and key personnel in budget, finance, and operations. Number three, you want to provide a clear process for reporting suspicious behavior. The Association for Certified Fraud Examiners conducts an annual global fraud study, and they consistently report that the most effective means of detecting fraud is tips. In the most recent study, tips were responsible for uncovering 43% reported cases of fraud. Now, that's much more than any other form of detection, like management reviews, inspections, audits, or even surveillance devices. While some nonprofits use a third-party reporting hotline for reporting suspicions about fraud, one of the most important things you can do is to create a culture where employees know that the nonprofit's reputation and mission depends on their willingness to report suspicions. This tends to be less costly and equally effective. Number four, and I think that this is so important, think through what your organization will do if you receive a report or complaint. We see all too many cases where an organization had a reporting system, but reports were mishandled or simply ignored. In the United States, recent cases against the National Rifle Association, the Catholic Diocese of Buffalo, and the United States Gymnastics Association all involve breakdowns in reporting and investigation. So your organization needs to think through who will receive the report, who will evaluate if it's credible, and if it is deemed credible, what happens next. Conduct some exercises with the relevant directors and employees with realistic hypothetical scenarios. When you hear about a scandal at another organization, use that as a learning opportunity to think how your organization would handle that situation. Let other people's scandals and their outcomes be a lesson for your practices. Be sure to include examples involving senior leadership and directors, because these can be the most sensitive and the costliest cases. The appropriate examples will depend on the nature and size of your organization, but here are a few examples of hypotheticals to think through. Number one, a program officer lodges a complaint that a board member who traveled to a board meeting is now requesting reimbursement for both his and his spouse's expenses. What do? Number two, a member of the finance staff reports that the chief financial officer directed her to make payments to a new vendor without any documentation of what services were provided. What happens next? Number three, a member of the finance staff reports that a new technology vendor is in fact owned by a director's spouse. So what do? Number four, a social worker employed by your organization complains that the executive director is telling her to inflate the number of clients she has helped in a report to a grant maker. So what happens next? Now, many of you may be familiar with the fraud triangle, which illustrates the conditions that increase the risk of fraud. The three parts of the fraud triangle are pressure, rationalization, and opportunity. As regulators, we focus on opportunity. This element of the fraud triangle refers to the circumstances that allow fraud to occur. Without it, fraud becomes impossible. We tend to focus on this element because it's the only component of the fraud triangle over which the company exercises significant, or in some cases, complete control. From a regulator's point of view, the best fraud prevention tool a charity has is good governance. And to that end, one of the most important elements of a counter-fraud strategy is the right tone at the top. We hear this all the time. Mere mechanical compliance with internal controls can still leave the organization vulnerable, and that's why the attitude and actions of management and the directors are so important. Thank you very much for your attention, and thank you for your efforts to counter fraud in charities.